right, I'm going to have to work on that. Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. Today, we're going to be talking about whole life insurance, policy reviews, live illustrations, and actually, today, we're going to be going over one of my policies. So we've got an update on it. Our anniversary just happened, and we're going to take a look and see where that's at after a few years, after it's been enforced for a few years. How's it doing? We'll see if we can do an in-force illustration while we're on here today as well. I've got to work on that countdown, though. It's not actually counting down appropriately. That's kind of strange. Not sure what's going on with that. So we're still getting used to the new software that we're doing. We'll get better at this every week, every day that we go live. But I do have some things that I'll share with you. The policy that we're going to be going over is a policy that I have on my wife. Actually, I think she's the owner of it. And it's with Guardian, and we're going to see how that's doing. Let me double check and make sure that our sound is good. And it looks like everything is working good. All right, so when you join, be sure to hit that like button. Subscribe if you haven't subscribed so you can get notifications. Turn on the notification bell too so you can get notified when we go live. Our current plans are to do live streams on Tuesdays and Thursdays, 11 o'clock a.m. Pacific time. And on Tuesdays, we're going to do IULs and live IUL illustrations, policy reviews. On Thursdays, we're going to do whole life illustrations and policy reviews. So appreciate you joining us. My hope is that by providing as much transparency around products, product designs, illustrations, policy reviews, is that you're going to learn everything that you need to know to make sound financial decisions with regards to high cash value life insurance products. Whether you buy those from me or somebody else, it doesn't really matter. Our goal here is education. So you can certainly sign up for a meeting with me if you want to see anything in particular specific to your situation. You can do that at my Calendly, which is on my website. You can see a link to that on my website. The website is OregonCashFlowPro.com, and you can see a link scrolling along the bottom of our screen here that has my Calendly link right there. So Calendly.com/cashflowpro. And we do one-on-one consultations there. It's a great place to get specific questions answered for your situation and look at illustrations that are built on what you want to see. Let's jump into my policy. So I haven't reviewed this yet. I just pulled up the information. I made a paid up additions payment yesterday, and so it just registered. I maxed out for this following year. Let me show you what we're looking at. Here we go. So this is my wife's policy. You can see her name right there. This is a Guardian policy. We make payments of $512.50 each month. That's our base. That covers the base whole life of the design and the cost of the term insurance that we have blended in with this. So we have a total of $2.15 million in death benefit. Now there's a loan outstanding, so that's why this is the net death benefit right now. Okay, we've got an outstanding loan right here. And then we have our cash value. This is what it looks like from the client side. Okay, now I can go in here and we can look at the details, but those don't really matter to us much. What matters is this. What's our cash value? If I wanted to walk away from the policy right now, I can't take this because I have a loan, but I can take this minus the loan, minus whatever interest is already owed on my loan. Okay, but this is our cash value. Generally, your cash value is your surrender value if you don't have any loans. If you wanted to, you could just take that cash, walk away. You might have to pay taxes if there was gains on it. Okay, so that's the base of our policy. Now let's look at this from the agent side. We're going to get a lot more information here. And I did figure out how I can black out some important stuff, which allows me to be able to share this all with you without concern that this is on the internet. Okay, so this is a report that I can generate as the agent on this policy. And we can see this is the same policy. This is our base amount here. So $6,000 is our base. Remember, my monthly payment was $512.50. That's this plus the charge for doing monthly payments. So we pay an extra, what, $60, $80 over the course of the year to do monthly payments on the base and my scheduled paid up additions, which also includes my 1-year term insurance. Okay. Our base face amount of whole life insurance, $321,000. We've got some death benefit from our dividends. We're paying for $668,000 in term insurance. That's a cost of $588 for this year. Okay. And then we have over $1 million in paid up additions that we've already generated. Okay. And then we have a cash value associated with those paid up additions. Because of the design that we do, all of our early cash value is here in these paid up additions. That is by design. And we have our totals here. Let me double check that. So our total cash value reported to the client was $279,374. This one shows $278,835. So we've got a difference of about $500. I'm not sure what that difference is right now because I haven't looked into that. It's a slight difference. It might be that one is already included on the client side. That's including some dividend that I'm not seeing right here, at least in these particular numbers. So moving down, there's our total death benefit, $2.1 million. Okay, then we have our basic cash values, which when you add these two together, adds up to right here, the $7,900. And it's showing that as of our next policy anniversary. So this is how much it's going to grow this year. Okay. Here's our outstanding loan interest. Guardian withholds it. It's prepaid interest. So it's a loan interest in my policy. It's a 6% loan interest. But because they withhold it at the beginning, it's like 5.6, something like that. It's not 6%. It would be 6%. It's the equivalent of 6% if they charged it at the end of the year. But because they charge at the beginning, they charge you a lower number. Okay. This is our outstanding premium. This is our next month's payment that gets made. So that's our $512.50. That's going to be coming out next month. Here is our total values. Now, one of the things, if a client reaches out to me and says, hey, how much space do I have available to put into my policy before I MEC? I'm going to look to this spot right here. This is our max unscheduled EPUA payment before MEC. Now, I'm maxed out for the year, so it says 0 for me. Okay. We can look at the previous year's cost of insurance. So it was $832 last year. What is it this year? $588. Okay, that's because I made paid up additions payment. I made a paid up additions payment. It reduced the amount of term insurance that we have to pay for. So even though this is annual renewable term, she did get a year older, our cost of insurance went down by quite a bit because we're paying for less of it. That's how the Guardian term insurance blend works. Every year, as long as we're max funding this thing, the amount of term insurance we're going to need to be paying for goes down. And the cost of it should go down, unless we're at an age where the cost of it goes up more than we've paid it down, right? But with our plan, the way it's currently set up, this term insurance is going to be gone within the next couple of years. I think 3 more years. So you can see we started this policy March of 2020. So we've made a 2020 payment, 2021 payment, 2022 payment, and we just made our 2023 payment. Now, what we're looking at is the totals after right immediately after my fourth payment. We're almost at a break even. You can see our policy cost basis was $289. And remember, our value was $279. Cash value was $279. So we're off by about 10 grand here, but realize I just made 60,000 plus in paid up additions payments. And those come with a load fee that takes them right off the top. So prior to me making those payments, I was like right at break even after the end of my third year, right? 2020, 2021, 2022. So right at the end of my third year, I was really, really close. I'm just behind my break even. But because I made my paid up additions payments, it makes it look like we're a little bit farther away because we're not going to get credit for those till the end of this year. Does that make sense? Drop me a comment if everything is making sense so far. And if you have any specific questions with regard to what we're going over. So you can see our monthly modal premium, the billing class, that's Guard-O-Matic. That's what Guardian calls their monthly payment plan. My last transaction just happened. You can see that right down here. So I made a paid up additions payment of $46,000. So I made two payments. I made a payment of $20,000 the day after my policy renewed, which was on the 1st of March. And then I just made another one, $46,498. And that maxed us out for the year. Okay. We've got a loan outstanding of $162, and we've got a loan available of just over $100,000. Okay. Here's that loan rate, 5.66%. That's because it's paid in advance. Now, current people who are buying Guardian policies, the loan rate is 5%. And that's a fixed rate. It doesn't change. So what their number would look like would be more like 4.66 right here because it's charged ahead of time. Thank you, Gil. Appreciate the comment. There's our loan payoff. So current outstanding loan, we have a little bit of interest that's accrued already. Okay. If we wait till the end of the year, this is the amount of interest in total that we'll pay on that loan, assuming the loan balance stays the same. Now, the loan balance could go up, could go down, depending on what goes on throughout the year, and this number will change. Okay. But this is the amount that they withheld based on this and what that would cost for the whole year. Okay, then we got our paid up additions. So we can see I made a paid up additions payment of $46,000. That bought us $189,000 in death benefit. That's a paid up addition. That's like a little miniature life insurance policy that we just bought. That $189,000 reduced our term insurance by $189,000. That's why our cost of insurance is a couple $100 less this year than the last year. Okay, so the total 1 year term that we have now, $668. That should match right up here. $668. Okay, so that's all that we have left to replace. So at $668, that's what? Let's go back here. Just over 3 more years of paid up additions payments. Does that sound right? Yeah, it's just over 3 years. So that means I'm going to have all of this term insurance gone and replaced by permanent paid up additions in our 7th year. So 3 more payments, maybe just into the 4th one. Now, when I set up this plan, this was pretty cool. When I set up this plan, my plan was I set it up with a $5,000 base. Let's go back up here. Here's our base, $5,000. Now we know if you've been paying attention to our videos, you've been looking into Guardian, you know, our designs that we try and do is a 10-to-1 design or a 9-to-1 design. You put in $5,000 for a base, but you can put in $50,000 for the year. Well, if we add extra death benefit, because of how Guardians works, if we add extra death benefit, we can pay in for longer number of years before that term insurance burns off. If we add more term insurance, we can pay $50,000 a year for more years. So I had this policy set in our original design that I was going to pay $50,000 a year for like 13 years, something like that. I don't remember the exact numbers. It was 4 years ago or three years ago, right? But our MEC limit is based on the death benefit. And if we increase the death benefit in order to pay more years of 50,000, our MEC limit goes up. In Guardian's current practices, they will let you pay up to the MEC limit. If you send in the money, they will accept it without you having to go through underwriting. Pretty cool deal. So what I've been sending in has not been 50,000. I've been sending in 72,000 a year. I've been making the $6,000 payments and then 66,000 in paid up additions. And they accept it, even though that's clearly more than 10 times my base. Pretty cool. So I'm burning this term insurance off faster than the original plan that we had. So rather than 13 years at 50,000, I'm going to end up at 7 years of 72,000. Ultimately, I'm going to put in less money, but because I got my money in sooner, the cost of that term insurance went away quicker. I get more years of compounding on those dollars because I got it in sooner. And I should end up with a more efficient policy. Now, I believe we did a review on this policy last year, and we were ahead of our illustration, slightly ahead of our illustration. So we're going to see if we can do that again today and see where we're at. We should be slightly ahead of our illustration still. All right, so I'm going to bring up, I'm going to have to see if I can do this. Hang on a second. This might take me a minute, so bear with me. Converse amongst yourselves. Got to turn this into an in-force illustration. And I can't do that with everything being public. All right, let's see if we can do this. All right, I'm building this now. So give me just a second. I know this is dry content, but this is going to be the limitations of us being able to do this stuff live. Just know that I am working on it behind the scenes here. We're getting the in-force illustration numbers input. And you're going to see this when I see it. So if there's any surprises, positive or negative, you get to enjoy it right alongside me. So let's see. I'm going to have, we maxed out for this year. scheduled. Okay, unscheduled. We're going to do years 5 through max 50,000. Actually, I'm going to have to cut that off probably after year 8. Let's see if that is accurate. Okay, that works, but I get a mech, so I got to make an adjustment in my contributions. We will make that adjustment right there. Yeah, gotta stop. Okay, this is projecting we'll be out of term insurance after year 7. So I've got to do that. Oh, no, it does take a small payment in year 8. Okay, that works. Let me make an adjustment there. Sometimes we got to play around with these things to get these numbers accurate. Let's go here in year 8. Hector, how you doing? Okay, that doesn't work. That becomes a mech. Oh, I know why. I know why I'm getting a mech. Okay. It's because this is unscheduled and I need to reduce that down to 44. I always do that when I'm doing the in-force. I'm so used to putting in the total and not just the scheduled or unscheduled. Uh-oh, am I getting a hiccup on here? Our software is freezing up. Let me try and refresh. Oh no, it's making me totally log back in. What the heck? Oh good, it kept the information. I thought it was going to kick us out of all that. All right, let's make this 44,000. Hear that. Here. Let's see if we can do 1,000 max. See if we can do that without it giving us an error. No, I'm gonna get a mech. Okay, what did it do? Right there. Might just be too much going in that year. We're almost there. I think we're almost there. You're welcome, Hector. Gil, how many in-force illustrations can you do in a year? Can you? I mean, there's no limit. You can go in and play around with it anytime you want to. I guess you're just going to be limited on how much time it takes you to do it. Okay, this doesn't give us a mech. But something is off. What is off? Something's off. What's going on? Oh, it's because I have a loan outstanding. The loan always screws everything up. Okay, so let me put in a loan payback. Let's pay back our loan this year, so as if there is no loan. So we're going to put in a loan repayment with cash, and we're going to pay 100 and what was our outstanding loan amount? 162, and then we got a few thousand interest. So 163,631. Let's put that 163,631. Let's see if that fixes it. Anytime we have outstanding loans, it kind of screws up your numbers. Okay, this is actually looking good. This is looking good. All right, I'm going to share this side with you because there's some things that we want to look at up here that you can't see in a PDF. So take a look at this. Here we go. Let me see if I can make this bigger. I don't think I can. I don't think I can make it bigger. All right, so do want to make that wider. Up here at the top, this is some of the other illustrations that I've done on this. This one right here, number 11, this is the last in-force illustration I did. So I think this was last year. I've made a paid up additions payment. I mean, we've paid some extra. Up here at the top was a final illustration. So that was like our original, okay? That was the original, which is like your minimum funded design, okay? Not a maximum funded design, minimum funded design, which we turn in to get approved. So our cash value over here, we can look at projected cash value at age 75. This would be like if I minimum funded this policy. If I never put in any extra paid up additions, I wouldn't have hardly any cash value. The plan right above that does have our normal plan that went along with it. And you can see what our cash value projected to be. So this was when I started the policy. This was essentially a max funded design when we started the policy. By age 85, I was projected to have just over $2 million in cash value. Okay. That was remember, 13 years of payments of $50,000. Well, we've been accelerating that. We've been paying more than that sooner. And ultimately, we're going to end up putting in less money over the course of that time. So we're not going to put in for 13 years. It'll be slightly less dollars, total dollars that we put in, but it'll have more years of compounding. And here's been the reality. So last year, I didn't put a date on it here. I should have, but this should be last year. The projection was up to 2.25 million by age 85. Now I've accelerated that even farther by dumping in money this year. And now our projection by age 85 is now 2.3. So we've been increasing the projected payout because we've accelerated what we've put into the policy. Okay, so let's look at, let me turn this into a PDF and we'll go through the PDF. Let me bring this back down. And I'm going to see if I can pull up, I don't know if I have an original PDF, but I might have the in-force illustration that we did the last time. I'm going to have to take a look at my records. I didn't do a good job when I first started this of saving those illustrations. And I can't go back and reprint them because it's an old product. I can't go back and recreate them with what it would have originally been. So unfortunate, but that is the situation we find ourselves in. Okay, so here's our in-force illustration. You can see it says in-force. Our relevant values. This is the expected funding. Now I'm limited. I can't put in what I'm actually going to fund it at. So we should still continue to see these numbers get better. You can see we burn off that term insurance here, and then our death benefit starts to go up. At this point, this death benefit is made up of all permanent paid up additions and our base whole life. There's no more term insurance tied to that. And this is our cash, projected cash values. Now we're going off the current, not the guaranteed. The guaranteed assumes no dividend payments ever, okay, from then on. It still continues to go up. That's why we get whole life. That's why we like whole life. We're going to get that guaranteed growth. When the market was crashing last year, I didn't worry about it at all because my policy is still growing, okay, by a guaranteed amount. And our dividend rate actually went up from 5.65 to 5.75. Hopefully we'll continue to see that happening. These higher interest rate environments, not good for a lot of businesses, but it is good for the insurance business. So we should see these, the dividend rates continue to creep up. Let me see. I'm going to leave this up here. You guys can watch that. I'm going to see if I can find an older in-force illustration on this policy. Okay, let's see. Do have an illustration from February of 2020. This might be the original, not a max funded. Let's see. This does have the full first year. Does it have each year? No, it doesn't. This is not our max funded design. Let's see. Let's get to the meat of this illustration. Yeah, this just has 50 for the first year. Bummer. This is not the max funded design. This is our minimum funded design as we started the policy. So clearly we're doing better than what this one projected because we put quite a bit more money into it. So let's get rid of this. Let me see. I did another one. a couple months before that. Maybe this is a max funded design. Let's see. It's also a minimum funded. Darn it. I didn't think I did one. I thought that I neglected to do that for this policy. That's unfortunate. I don't think I have one. I'm not seeing it. Not seeing it in here. I don't even see an in-force illustration in here. That's strange. See, nowadays I do a good job of saving our max funded designs because that's our benchmark. We want to beat that original illustration. But if we didn't save it, then I'm not sure how to find it again. So I know I don't have it there. Is there anywhere else I might have saved it? I'm looking for you guys. Nope. Not there. Man, well, this is a bummer. Don't think. I did save a max funding for my policy. When we get to my policy review, my anniversary date isn't for a little while, but when we get to mine, we'll be able to look up the last one. I wonder if I did. Let me check YouTube. Maybe I did a video on this policy that we reviewed last year. Let's see. My national life policies. I've got a 2-year cash value update. Let's see what this one. Let's take a look at this. All right, which policy? That's my wife's policy. All right, this should be my wife's policy. What do we got? What do we got? Okay, so this has our cash value. Do we do an illustration? This is her policy. We can see it had a date, the same date there. Okay. Cost basis at that time was 144,000. Did we do an in-force? Tell me we did an in-force. This is too short of a video. I don't think we did an in-force. Oh no. We didn't. We didn't do an in-force. Oh man. Okay, well, scratch that. I guess today's going to be kind of a bust. We're not going to be able to compare this. But this video, I will put this out here. We're going to have this. So we'll be able to follow up in the following years. We'll keep track of it and we'll have this up there. And I am saving these in-force illustrations. All right, let me see if I can go back to here. And let's see if we can look at the details of this the in-force illustration I did the last time. Usually it doesn't work because it's going to try and pull in all of the information. I'll just pull this up here. So current policy year, this one says 3. We're now in policy year 4. So this hasn't updated. But if I hit calculate, I don't think it's going to have all of the right numbers in here. So this was paid through, paid through the last year. We had our base face, target additional. What did we put for a design? So in this case, 44,000 through year 8, 12,000 in year 9. So we have something similar in this one. We added 44, which got us up to 50. And then I added 12 extra. So I did add a little more in this one than I did in that one. So we're not looking at exactly apples to apples with what we're putting in. So it should turn into more cash value, not just because the current one we're doing is a little more efficient. I am illustrating putting in a little bit more money. I'm going to hit calculate on this. I don't think it's going to work. I wonder if these numbers will all change if I do that. Actually, let's copy this one. See if it'll copy it exactly, and then we'll hit calculate and see if it will allow the illustration to show. I don't think it will, but doesn't hurt to try. Can't be illustrated because it's greater than 10 days old. Yeah, okay. I expected that would happen. So unfortunately, I can't recreate an old in-force illustration. Let's get rid of that. So I don't want to make changes here. We're going to see these numbers. I'll leave those alone so we can still see what they would have been. And we'll have something to compare to in the future. So we'll just save this as is, and we'll come back to it in the future. But as for now, we're going to just have to go with what we got. We've got our current in-force illustration. We saw that it was the cash growth was projected to be higher than what it was last year when we did our in-force illustration, but I didn't save the stinking thing. If I find it, I'm going to cut out this part of the video here from today, and we'll make its own video. I'm going to add it into that video if I find it. So any questions from you fine folks out there? Any questions with regard to what you saw as far as projections that we're doing, funding questions, anything at all. If you have any questions and you're not on this live one, put them in the comment section. I always answer every comment, every question in the comment section that I see. And sometimes I turn those questions into videos as well. So if you have some questions, that tells me that there might have been something that I missed when it comes to going over this stuff. And oftentimes it might make for a good video because other people are probably interested. Other people probably have the same questions that you do. I'll just finish scrolling through this illustration so we have this on record with all the actual numbers. There we go. So there's our actual numbers. And with that, we're going to call this policy review done for today. So if I see no questions there, we're gonna end today's live stream. I'll work on putting this stuff out there into regular content that people don't have to sit through all those periods where I'm looking up stuff, such as the challenges that we have to go through with our live stream. But hopefully you found some value, and we'll be back again next week. If you have any ideas on things you'd like to see illustrated, doesn't have to be Guardian. We can do Mass Mutual, Penn Mutual, Lafayette Life. As far as whole life goes, I can illustrate that. National Life, I'm contracted with a lot of carriers. I just don't usually illustrate their products too much because they're not great products. But some of them are. Generally we like Mass Mutual, Penn Mutual, and Guardian in the whole life space. Lafayette Life can be okay. We can do good designs with all of those ones where we're meaning good cash value available. Some of those other ones, they're not as attractive. We can certainly do illustrations on them, but they're not going to be attractive illustrations from a cash growth perspective. So with that, I think we'll call it a day for this one, but we're going to be back Tuesday for IUL, live illustrations or policy reviews. Next Thursday will be whole life again. And as my policies come up for renewal, I'm going to do my policy reviews. So I think next Tuesday on the IUL illustration, I think it's time to look at my national life policies, do an updated review on that one. Coming up soon will be my Mass Mutual policy renewal. And then later on this year will be my Guardian policy renewal. So we've got that to look forward to. So I appreciate you guys joining me. With that, we're going to call it a day. We'll see you next time. In the meantime, check out my videos on my channel. We've got so much good information with regard to all things cash value, life insurance, ideas on how to help fund these things, dynamic banking, infinite banking, you name it. We got some information on it to help you maximize your cash flow. So thanks, and we'll see you next time.